Warren Buffett, the long-serving CEO of Berkshire Hathaway, is not only a master of stock investing, but also a wise philosopher of finance. He has a special talent for turning complicated ideas into simple, easy-to-remember rules. Today, we're going to explore 3 of his most important rules, designed specially for people who are just starting to learn about investing. These rules are like bright guiding stars in the sometimes confusing world of investing, and they'll help you make smarter choices with your money. Let's jump in and uncover the straightforward wisdom of Warren Buffett's 3 simple rules for beginners. Rule number 1: preserving your capital. Warren Buffett's first rule, the golden commandment of investing, stands resolute as never lose money. At first glance, it might appear paradoxical that a man who personally witnessed the evaporation of around $25 billion during the tumultuous financial crisis of 2008, which also led to his company, Berkshire Hathaway, losing its revered AAA rating, would impart such advice. However, delving deeper reveals that Buffett's rule number 1 is not a magical incantation to ward off market volatility, but a profound reminder of the mindset a shrewd investor must cultivate. Buffett's rule underscores the need to avoid financial recklessness and to resist the allure of impulsive decisions when navigating the complex world of investments. It serves as a clarion call against frivolity and excessive risk-taking, rather than promoting a cavalier attitude that accepts investment losses as a mere cost of doing business. Buffett's wisdom demands that investors be diligent and well-informed. It's a clarion call to do your homework diligently, to understand the companies you invest in as thoroughly as Buffett himself does. Warren Buffett is renowned for his painstaking research and comprehension of a business before committing capital to it. His principle is simple but profound. Do not approach an investment with the expectation of losing money, and always be prepared to defend your choices with sound reasoning and evidence. In a world where speculation and whims can lead to financial ruin, Buffett's guidance serves as a lighthouse of prudence. Beyond intellect, Buffett places great importance on temperament as the foremost quality for an investor. It's about maintaining a steadfast and unwavering commitment to your investment objectives, regardless of the ebbs and flows of market sentiment. While the stock market may perpetually oscillate, a serious investor like Buffett remains resolute in their pursuit of long-term financial goals. So, the next time you hear the phrase, "never lose money," from the Oracle of Omaha himself, remember that it's not a guarantee against the vagaries of the market but a call to arms for disciplined, well-informed, and patient investors. Rule number 2: business success drives stock gains. In the grand tapestry of Warren Buffett's investment philosophy, rule number 2 weaves a compelling narrative. If the business does well, the stock eventually follows. This second rule in the Buffett playbook sheds light on his strategic approach, which revolves around identifying and nurturing investments in businesses with robust long-term prospects. When Buffett evaluates an investment opportunity, he doesn't fixate solely on stock prices or market trends. Instead, he delves deep into the core of the business itself. He seeks out companies with a consistent track record of performance, a commanding presence in their respective markets, and the ability to generate sustainable profit margins over time. These are the kind of businesses that attract Buffett's discerning eye, especially if their share prices are trading below what he deems to be their intrinsic value based on future growth potential. Buffett's philosophy encourages investors to adopt a structured and methodical approach to decision-making. Much like the Oracle of Omaha, anyone considering an investment should be able to articulate their rationale for paying a specific price per share. This exercise serves as a litmus test, refining investment choices and aligning them with long-term objectives. By emphasizing the symbiotic relationship between business performance and stock returns, rule number 2 imparts a profound lesson. The stock market is ultimately a reflection of the underlying businesses. When businesses thrive, stockholders stand to benefit. This principle underscores the importance of diligent research and a focus on intrinsic value, providing a compass for investors navigating the complex labyrinth of financial markets. By the way, if you're finding these insights valuable, don't forget to hit that like button and subscribe to our channel right now. Now, let's get back to exploring Warren Buffett's timeless investment rules. Rule number 3. Quality over bargains. Rule number 3, as articulated by Warren Buffett, imparts a critical lesson in investment strategy. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price. This rule is a cornerstone of Buffett's value investing philosophy, which emphasizes the importance of quality over bargain hunting. Buffett is known for his penchant for seeking out high-quality stocks at reasonable and sometimes even moderate prices. His overarching goal is to construct a portfolio of stocks not only generates solid profits, but also experiences sustained capital appreciation over the long haul. His approach is particularly evident in times of market turbulence, as was the case during the 2007 to 2009 financial crisis, when he seized the opportunity to accumulate long-term investments by injecting billions into companies like General Electric and Goldman Sachs. To effectively select stocks, disciplined investors establish their criteria and adhere to them unwaveringly. Much like Buffett, they might seek companies known for delivering a high-quality product or service, boasting robust operating earnings and demonstrating the potential for future profits. They might also set specific thresholds, such as a minimum market capitalization they are willing to accept, or maximum price to earnings or PE ratios, or debt levels they find acceptable. Ultimately, the crux of rule number 3 lies in understanding that the price paid for a stock doesn't equate to the value received in return. Successful investors comprehend this crucial distinction and, like Buffett, strive to acquire wonderful companies at prices that offer a margin of safety against unpredictable market risks. We mentioned that we would only present 3 pieces of advice from Warren Buffett. But since you've journeyed this far into Warren Buffett's realm of investment wisdom, here's a bonus piece of advice from your favorite investor. Bonus rule number 4, the eternal holding period. Buffett's commitment to long-term success. Warren Buffett is the ultimate proponent of the buy and hold philosophy. He espouses the idea that when you invest in a stock, you should be willing to hold onto it for the long haul, ideally for a decade or more. This sage advice encourages investors to adopt a patient and enduring perspective. Buffett's commitment to long holding periods served as a beacon of wisdom during the darkest days of the financial crisis, which he famously dubbed an economic Pearl Harbor. Rather than succumbing to panic or knee-jerk reactions, he retained the bulk of his portfolio. This steadfast approach helped him weather the storm and eventually emerge stronger than ever. The essence of rule number 4 lies in the understanding that hasty and emotional decisions can be detrimental to long-term portfolio growth. Unless a company experiences a profound shift in its prospects, such as insurmountable labor problems or product obsolescence, maintaining a long-term focus typically leads to more favorable outcomes. Being overly swayed by fear or greed can often result in selling stocks at market lows or buying them at their peaks, undermining portfolio growth over time. And there you have it, folks. We've unlocked the treasure chest of Warren Buffett's investment wisdom through 3 simple rules. But before we say goodbye, here's a question for you. Imagine you could have a chat with Warren Buffett and ask him one burning question about investing. What would that question be? Share your thoughts in the comments below. And hey, if you enjoy this journey through Buffett's wisdom and want more exciting content like this, give us a thumbs up by clicking the like button. Also, make sure to hit the subscribe button to stay tuned for more great stuff. Your support means the world to us, and we're here to make your financial adventure as awesome as possible.